Good morning, and welcome to TOI Japan Market Radio for March 2, 2026. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japanese equities, currency, and rates, offering a daily briefing on what's moving markets here. Let's dive straight into today's session.
Thanks for having me. Today's session was dominated by risk-off sentiment across Japanese equities. The Nikkei 225 closed at 58,057.238, down 1.348%, while the TOPIX ended at 4094.0, off 0.896%. The Mothers Index also declined 1.151% to 2405.0. On the positive side, J-REITs showed resilience, gaining 0.537% to 2061.0. In currency markets, USD JPY moved up 1.012% to 157.437. Commodities told a story of stress. Gold in yen terms surged 4.266% to 20,040.0, and crude oil jumped 8.132% to 72.47.
That oil move is quite striking. Let's talk about what drove today's sell-off. Tokyo stocks ended sharply lower on escalating geopolitical tensions related to Iran, with the Nikkei temporarily losing 2% intraday before paring some losses. What's the immediate concern here for Japanese markets?
The core issue is energy security and supply chain vulnerability. Japan imports roughly 80% of its crude oil, and a significant portion of that transits through the Strait of Hormuz, where Iran holds strategic influence. Any escalation in Middle East conflict raises immediate concerns about potential disruptions to oil supply, upward pressure on shipping insurance costs, and broader logistics expenses for Japanese manufacturers. This matters directly for corporate margins and inflation expectations.
So we're seeing a classic risk-off response in equities. Which sectors took the heaviest hits today?
Cyclical sectors bore the brunt: automotive, chemicals, and trading houses, all of which depend on stable energy prices and export demand. Energy importers face margin compression concerns if crude prices stay elevated. The temporary 2% intraday drop in the Nikkei reflects that flight from risk assets. For global investors, this is a reminder that Japan's economic recovery remains dependent on stable energy prices and uninterrupted global trade flows. Middle East instability is a direct headwind to both corporate earnings and consumer purchasing power.
And on the currency side, we actually saw the dollar strengthen against the yen today, with USD JPY up over 1%. That seems counterintuitive given the risk-off mood. What's your read on that move?
It's a bit of a divergence from the typical safe haven yen strength we'd expect. Part of the USD JPY move likely reflects positioning adjustments and possible intervention concerns at these elevated levels. However, if geopolitical tensions persist, we should expect renewed yen strength as flight to quality flows accelerate. That would create a headwind for Japanese exporters, as yen-converted repatriated earnings take a hit. For now, the market is balancing risk-off sentiment with dollar demand, but the trajectory remains uncertain.
Staying with the geopolitical theme, reports indicate that the US and Israel conducted a military attack on Iran, which directly triggered today's sell-off. How should global investors think about the duration of this risk?
The key watch is twofold. First, the trajectory of crude oil prices, and second, any updates on Strait of Hormuz shipping activity. If supply disruptions materialize or shipping insurance costs spike further, we'll see sustained pressure on Japanese equities, particularly energy-intensive sectors. On the flip side, Japanese energy companies could see mixed effects. Higher oil prices support earnings, but the broader market risk-off can offset those gains. For fixed income, we'd expect downward pressure on JGB yields as investors rotate into safe assets. The 10-year JGB yield may compress further, which actually supports the Bank of Japan's yield curve control framework in the near term.
So in the immediate term, the risk is tilted toward further equity weakness and potential yen strength if this escalates.
Exactly. And inflation concerns from potential crude disruptions could provide some offsetting upside pressure on yields, but that's secondary to the risk-off dynamic right now. Global investors need to monitor not just the headline geopolitical news, but the actual impact on shipping routes and energy price stability over the next few sessions.
Meanwhile, shifting away from geopolitics, there's some interesting corporate news out of the semiconductor space. ASML, the Dutch equipment maker, is reportedly developing next-generation chip-making tools designed specifically for AI chip production, going beyond current extreme ultraviolet lithography capabilities. Why does this matter for Japan's market?
This is significant for Japan's semiconductor ecosystem, particularly equipment suppliers and chipmakers. Japanese firms like Tokyo Electron and Screen Holdings supply complementary tools to ASML's systems. ASML's evolution in next-generation capabilities could create both partnership opportunities and competitive pressures for these suppliers. On the chipmaker side, companies like Sony Semiconductor and Renesas depend on access to leading-edge equipment to remain competitive in high-margin AI chip production. ASML's roadmap signals the technical trajectory they must prepare for, which could drive accelerated capital expenditure cycles.
So this could be positive for Japanese equipment suppliers and related semiconductor stocks?
Yes, particularly for Tokyo Electron and Screen Holdings. We'd expect cyclical semiconductor-related stocks to benefit from accelerated capex cycles as chipmakers race to adopt next-gen tools. Japanese chipmakers could also see improved medium-term margins if they successfully integrate these advanced capabilities. Additionally, Japan remains crucial to the semiconductor supply chain, materials, components, wafer production. So advances in tool technology could drive incremental demand for Japanese inputs.
And geopolitically, given how strategic semiconductor manufacturing has become, does this news have any implications for Japan's positioning?
Absolutely. Semiconductor supply chains are now a key element of economic security policy, particularly in the US-China-Japan triangle. Japan's role as a critical supplier and its potential involvement in export control frameworks remains pivotal. ASML's next-gen tools will likely be subject to export restrictions, and Japan's cooperation in those frameworks could shape its strategic leverage. For markets, this is more of a medium-term structural theme than an immediate catalyst, but it reinforces Japan's importance in the global tech supply chain.
On the market impact side, does this move the needle on currency or yields?
Not materially. This is a micro-level sector story rather than a macro-relevant catalyst. Yen and JGB yields are unlikely to react directly to ASML's roadmap announcements. Semiconductor strength is already somewhat priced into long-term yen weakness expectations, given Japan's export-oriented tech sector. The real impact is on individual equities within the semiconductor space, not the broader macro picture.
Shifting back to equities, given today's risk-off tone and the sector-specific dynamics we've discussed, what's the near-term outlook for the Nikkei and TOPIX?
Near term, the outlook hinges on two factors. First, whether Middle East tensions escalate further and sustain elevated crude prices, and second, how quickly risk appetite returns to global markets. If geopolitical risks fade, we could see a rebound in cyclical sectors and a recovery in the Nikkei. However, if tensions persist, expect continued pressure on export-sensitive and energy-intensive names. On the positive side, J-REITs resilience today suggests that domestic-focused income assets are holding up, which could offer some portfolio diversification for investors looking to hedge geopolitical risk.
And for global investors monitoring Japan exposure, what are the key themes to watch over the next few sessions?
3 themes stand out. First, oil prices and shipping routes. Any further disruption in the Strait of Hormuz would be a major negative for Japanese equities and inflation expectations. Second, yen moves. If we see sustained yen strength, that's a headwind for exporters and could prompt earnings revisions. Third, semiconductor capex. Watch for any announcements from Tokyo Electron or other suppliers related to next-gen tool demand. That could provide a positive offset to the broader risk-off sentiment.
To wrap up, today's session was dominated by geopolitical risk stemming from escalating Iran tensions, which weighed heavily on the Nikkei and TOPIX. Energy security concerns remain front and center for Japanese markets given their dependence on Middle East crude imports. At the same time, the semiconductor sector continues to offer structural tailwinds, particularly for equipment suppliers tied to next-gen AI chip production.
For global investors, the key takeaway is that Japan's equity market remains sensitive to both geopolitical shocks and structural shifts in technology supply chains. The near-term risk is tilted toward further volatility if Middle East tensions escalate, but the medium-term outlook for sectors like semiconductors remains constructive. As always, monitoring oil prices, yen moves, and Bank of Japan policy expectations will be critical.
That's all for today's briefing. If you're tracking Japan's markets or have exposure to Japanese equities, consider subscribing to TOI Japan Market Radio for daily updates. Thanks for listening, and we'll see you next time.